right now.
Well, I think unfortunately it's going to be a smaller crowd.
Yeah, which isn't a bad thing. You get to spend more time with people then.
Yeah, that's probably true. Um, I, Hopefully they have it in Chicago. I love it when it's in Chicago.
Yeah,
It's
no, that's put it in Chicago every year. Makes life
self,
easy.
selfishly speaking, of course. Oh, I know what I want to do. Let me make sure I pull up. See how people might be strolling in here. Um, what? Uh, how's the business been this week?
We've been very slow. I think futures has had some volatility, but really going nowhere fast. Where you got to get November off, and I think unfortunately we're down a little bit today, but November's still at a premium. Where realistically cash is trading. January's at a premium, so it's that leap of faith that, do I want to buy futures at this premium to cash? And I might not want to sell it, but how badly do you want to buy this premium? So we're just, I personally think we're stuck in a holding pattern here until you get November off next Monday.
That I could definitely see that. Some kind of very esoteric news. I think that the United States finally opening the borders to non-essential travel, um, could have a very bullish effect because there's a lot of people that will come work in the construction industry illegally that couldn't get into the country. So they say, "Oh, I'm just going to go in and visit someone," and then they stay and work construction for six
Yeah,
months.
no, I think when you look at the definition of construction workers, you've got the day laborers, you've got the skilled side, but there are a lot of unskilled day laborers that swing hammers and are told what to do, and it's certainly not going to hurt labor, that's for sure.
No, yeah, it's it is not a headwind by any stretch of the imagination. Um, all right, you know what? Let's kick this thing off. We're a couple minutes into it. Hello, everyone. Mike Wisniewski, CEO of Materials Exchange, and with me today, as always, Greg Kuda, Westline Capital. Greg, good afternoon.
Yeah, good afternoon, everybody. Good afternoon, Mike.
Uh, Apologize for the delayed start today. We're heading down to Louisville, and we had to get our house in order here. It's the NOLA Traders Market down in Louisville is what we're heading down to. Um, so let's get things going. I'm gonna flip over to show Greg's screen, and a very very important and misunderstood concept being talked about today, which is EFP, standing for Exchange for Physical. Um, which we're going to get to after we go through what's transpired since we last chatted. So, Greg, why don't we move on to the next slide and let's talk about things.
All right, Mike. So here we have a November daily chart from a week ago, 11/2. There really isn't a significant change week over week. We're still in this. If you look at it today, we fluctuated in this 630 to call it in the last week like a 585 type area. Still, and you'll see it here. This is the basis we've discussed time and time again. So we're still November physical cash is still at a $10 discount to November. The flip side, November is still at a premium to where physical cash is based upon Random Lengths print. So historically speaking, November should be at a $17 discount. It's still carrying a premium relative to print right now. So, November goes off, expires next Monday. Long story short, we need to get November off the board, and then I think you'll see some more activity, some more trading once that transpires. Jump to the next slide. Here's your Nov-Jan spread. Again, this is the difference between November and January futures.
This was a
Uh,
week ago, huh? Yep,
yeah, a
that's right.
week ago, again, when we spoke exactly a week ago, that spread had narrowed into somewhere in the negative 30 to negative $25 area. Fast forward to this past week. Again, this was a week ago right here. We actually traded back out to a negative 85 area, and we've kind of flatlined now in this negative 60, negative 50, negative 65 to negative 45 area, which is still historically an extremely wide negative spread. Historically speaking, we should be somewhere in the negative 15 to negative 25 area. But again, November's had to collapse into physical cash. And then as you flip to the, as I flip to the next slide here, January, you can see week over week, January, we basically bottomed into our last meeting, Mike. And then you can see here's that bottom from a week ago. The market rallied from 590. It rallied, believe it or not, all the way to $700. And since then, we've traded back into this 640 area. But when you, again, rationalize this from a basis standpoint, historically speaking, January should be somewhere similar to that November contract. It should be at a $20 discount to physical cash. Call it $10, $15 discount. January still carrying a $73 premium to cash right now. So that explains that divergence in that Nov-Jan spread, and that November is physical cash right now. January is February 1st wood and beyond, so it justifies some kind of cost to carry or higher premium.
So
here's open interest. I'm sorry, Mike, go ahead.
A whole lot of boring, basically.
Yeah, a whole lot. That's why I'm trying to run through this so we can get to the meat part here. Here's open interest.
I'd like to put a caveat to that. Whole lot of boring, and January rallied 100. And $100 and came off $50.
Yeah, so, go back to the volatility podcast. There you go.
Yeah, so it's boring that it's going sideways in this massive range from a historical standpoint. But yeah, we call this one sharply sideways.
Yeah, sharply, violently sideways. Yep. And so here's open interest. So a week ago, we were still in a declining, liquidating structure where November was liquidating. You had the slight, liquidation of Jan and March. So open interest is over 1,700. In the last week, you can see we've given up 100 plus contracts. So January has actually, you look at January and March, you look at predominantly, you've taken it out of November. You've added a little bit in Jan and March, but the net open interest is still down. And, as of last Thursday, Friday, at one point, this dipped under 1,600. We're back above 1,600, but we're at historically low levels. And to kind of jump into the CFTC commitment of traders, this was the last report. And then you can see the decrease down 243. You've had liquidation from commercial longs, commercial shorts, not a big change with the swap dealers, managed money, momentum traders. Again, you had a market rally up to from 590 up to 700. Once the momentum buy side stopped, the market went hard the other direction, first in, last out. So the longs that chased that move to 700 on this move back to 640 got flushed back out, and then you had some momentum type selling coming in as well. And again, the net effect is a bigger loss of open interest week over week. And then, Mike, this is reflected here. So here we are, real time. The orange line is 2021, and you can see we're historically low from an open interest standpoint. But heading into that time frame where seasonally we should begin to bottom out, and everybody starts to think about Q1 type needs referenced over here, where we should start to build open interest from this point on. Once you get November out of the way, there should be a build of open interest.
Yeah, that's a pretty compelling first quarter or first beginning of the year. Open interest is jumps pretty much across the board. Only a couple times.
Yeah. Again, everybody churns the page on the existing year and starts to focus on their spring needs. And I don't see why this would be any different in that, by all indications, I think the building season looks strong for Q1, and everybody will start to focus on what lies ahead as far as accumulation of their future needs here.
Absolutely. And the dip in open interest doesn't surprise me in sideways markets. That's kind of what it's they're liquidating markets. Everyone's just kind of getting out. It's just moving a little bit sideways. It's the trending markets is where people generally try to start to get in.
Yeah, and again, when you have a move like this where you annihilate the longs, you have this violent move to the downside, you bottom, you reverse course. These don't look like big moves, but from a dollars and cents standpoint, they're big moves. And so to kind of, you draw a straight line here, you could say, well, the mean price is somewhere in the 650 area, but you're violently moving around to get that mean price. And in the process of doing that, you have a tendency to whipsaw and just annihilate open interest. And that's exactly what we've seen here.
So I'm curious. I wonder if, let's just say we trade in a $300 range for the next 6 months. Would you see open interest increasing, you think?
I think that historically speaking, we used to trade in $70 to $120 price ranges. And so if you're under the premise that we've evolved into something bigger as far as pricing, there's inflation involved in lumber. The old days of lumber being at 350 to 450 has evolved into, let's say 550 to 750, or that 550 to 850, that $300 price range, then yeah, that supports wider price bands. And I think if you have some kind of, even though it's significantly larger than what we're used to, but last year you had $700, $1,000 price swings. So if you could tell the industry you're going to swing in a $300 price range, yeah, I think you would give comfort and build open interest. It's still, from a volatility stand, a big price range, but at least it's definable. And I think when it comes to trading, people like something to sink their teeth in, as far as, okay, we're going to be stuck in this range. We can live in this range as long as we know what the range is. But when you come out of a year like last year and your range is 280 some dollars to $1,700, that's just way too much, way too big of a range. So long, yeah, I think $300 would definitely add open interest and comfort to this market.
I agree. I do think we're going to be a little more stable this next year. Everyone's prepared for it. There's less unknowns in the market as we move forward.
Yeah,
We're
absolutely.
we're in
I
the middle
absolutely
of,
agree.
from an election standpoint, we're kind of in the middle of a time frame. Obviously we're dealing with pandemic issues, but I think moving forward, there's more knowns than there are unknowns floating in people's brains. So
Yeah, we have a year under our belts and dealing with this, and it makes life a little bit easier.
yeah. So let's move on to the topic at hand, which I think this is, if in futures there's one thing that's more talked about and less understood, I think you'd be hard pressed to find it. Exchange for physical, EFP. What the heck is that?
Yeah, so I mean, it sounds like this confusing transaction. You just have to look at it this way. You've got two markets. You've got the physical cash market, your traditional physical cash market. You've got the derivation of cash in the futures market. So you have a transaction where you combine the two together. So you have two known counterparties. You've got the buy side, you've got the sell side, and there's a conversion or an exchange, that's exchange, of an existing futures position for an underlying physical cash position at a set price. So you're exchanging your futures contract for a physical cash car. That's, in its simplest form, that's all you're doing. You're taking a futures position and exchanging it for a physical car of cash. There are four sides of.
Oh, did Greg freeze up on us? I know the world is having some issues with Xfinity. Historically, that transaction was called an X-pit, which stands for, meaning it happened outside of the trading pit. And of course, we don't have trading pits anymore. So it's the first thing to understand is it's a privately negotiated transaction between the buyer and seller. Oh, here we go. Greg came. Greg, you froze up on us for a second there.
Yeah, something, there was some kind of internet outage here. I apologize.
And is your screen ready to go back up?
Yeah, let me pull that back up here.
All right. There we go.
Let's see. Can you see? Yeah, okay, there we go. So I don't know where I cut out at, but basically there are four sides of a transaction. You've got your traditional cash side where you buy cash, you sell cash. And then you've got the future side of it where you buy and sell the futures. So you combine all four and you've got the exchange for a physical.
All right, let's play a game here. Let's.
Yep.
I'll be the buyer, and you're the seller. So I bought November futures on Monday or yesterday. We'll just say why not. So I bought yesterday, and gosh, I don't even where was Nov trading yesterday? Probably around 5.
You were between 590 to 630.
Perfect. I bought $600 yesterday, right on the button, and you actually had sold, let's say, a few weeks back at 700. Now we talked to each other, and you happen to be. You don't even have to be a lumber mill. I think that's kind of interesting, right? Right?
Yeah, no, absolutely.
So let's just say you are a wholesale distributor, and you don't have to be a lumber yard to buy this. Let's just say that I am a truss manufacturer. All right. And what I want to buy is actually 2x4 1650, all 12 footers. I want to buy one straight rail car of 2x4 12 foot 1650 SPF. So I call you up and I say, hey, I'd like to buy this car. You wouldn't happen to be short futures, would you? I'd like to offset a futures contract that I have long. And you say, well,
Yes.
I just so happen to. What do we do next?
Yeah. So and I kind of have a similar example. I'm going to go back to this slide. So you have to understand that you've got your physical cash side of the transaction that you're going to do day in and day out. So you're always, again, we're the two counterparties, Mike. You're the counterparty, I'm the counterparty, I'm the wholesale distributor, you're the trust guy. So those are the two counterparties. Okay, so that's the counterparties. There's always two counterparties to an EFP. And on the physical cash side of it, you know what you want to buy. Okay, 2x4 1650. So you're going to negotiate species, tally, and that's the big misnomer, is that an EFP does not always have to be Western SPF. It can be Eastern SPF. It can be Southern Yellow Pine. It can be fir. It can be Eastern Boston studs. It can be MSR. It can be anything you want it to be, as long as the counterparties agree on that species and that tally. So you're going to negotiate like you traditionally would, species, tally of what you want. You're going to come up, your price is going to be a derivation of what's the freight. So what does it cost to ship wood from point A to point B? And then the other part of this is there an adder or a deductor? So we have to correlate it somehow to futures. And as long as there is a correlation to futures, we can correlate by using an adder or a deductor, and we can adjust that to create a strike price. And that's the agreed upon price that we're going to transact that physical cash load of lumber. And then the third part of this is the timing of it. When are we going to ship this wood?
When is there a window that it has to ship in?
So you can see down here, 95% of EFPs are typically transacted within the spot month. So you'll see with November futures here, and I wouldn't expect a significant amount of EFPs to transact for November, but 95% of those will be transacted in the spot month. And so here's the beauty of an EFP. I could EFP a contract of January lumber with you today. I don't have to wait to that spot month. I don't have to wait. Timing wise, I could EFP a contract. If both counterparties agreed to it today, we could EFP that physical January and say, you know what, we're going to match our futures positions today. but I'm not going to ship you that wood until some point in time. So the transaction doesn't necessarily have to be completed on both sides. You're going to have the physical cash side of it, you're going to have the futures side of it, but the actual shipment of the cash is negotiated between both counterparties. So the idea of again, most of them will take place in the spot month, but they don't necessarily have to take place in the spot month.
All right. So in our example here, um, I've got long futures at 600. You got short futures at 700. We are going to say that.
Yeah, and if you, I'm like, I'm sorry to, but here's an example. Like I have basically in this example, I've got a distribution yard that's long futures at 575, and so what would be the, like, okay, print is somewhere in this 575 to 580 area. Futures right now is in the 589 to 9, I'm sorry, 590, let's say, area. So I think that I want to buy futures. And let's say that I bought this 575 last week because it was a discount to where cash was. West Fraser, I'm going to use a sawmill, is 610 ask today. I want to buy cheaper than where I traditionally would buy from a sawmill, so I'm going to buy this 575 in futures. And then the other side, a sawmill on the rally sold 650. Let's say it could have done this last week. And so you've got a distribution that's long futures at 575. You've got a sawmill that's short futures at 650. So I'm just going to reference last week's random length print price was 585 or thereabouts. So we're going to use this 585 as our strike price. So both parties agree on the physical cash car. So you negotiate, what do you want from a tally standpoint? What's the freight? What's the shipment time? Just like you would negotiate a normal physical carload of cash, you're going to do the same on this. You're going to agree upon a strike price, which in this case is 585. And so again, there's 4 sides of this transaction. So ABC buys a physical carload of cash, so they're going to offset their futures. They own futures at 575. They're going to strike that off at 585. So this is the future side of the transaction. There's a buy and a sell. So this is the, again, 4 sides. This is the future side of the transaction. You have a buy at 575. You strike it out at 585 and churn. ABC negotiates, and they're going to take physical delivery of carload of cash now at 585. They'll own that 585, and then at some point they'll sell that physical cash. So that would complete the cash side of the transaction. And so on the flip side of this, the sawmill, basically sawmills are always long. They're always producing lumber. So that 585 strike, they're going to sell a car of cash out of their yard at 585, but then they're also going to cover their future short that they were short at 650. They're buying that back at 585. So that's the offsetting transaction in futures. They're liquidating a cash car at 585. So both sides of the transaction ultimately buy and sell futures, and then ultimately buy and sell the cash.
Perfect. All right. Let's talk my example because I think let's take the mill and the lumber dealer out to show how it can work for anyone.
Yep, perfect.
You sold at 700 in futures. I bought at 600. Today, futures is trading at 650, right in the middle of the two of us, right?
Yep.
Around 650. So we start to negotiate on this car of 2x6 or 2x4, all 12 foot, 1650. And you say to me, you know what? If you give me $100 over where the futures price is, I will sell you that car delivered into your yard. I just so happen to be in Columbus, Ohio, right? And you're able to secure that wood from an Eastern mill,
Yep.
Eastern Canadian mill. Great. I go, okay, $100 over futures today. That says 650. That'll be like a 750 delivered into me. You know what? That sounds fine. I'll buy that car. I will pay you $750 per thousand for a car of 2x4, 1650 MSR. You're like, great. We actually do that deal out in the cash market, and then we agree that we're going to offset our futures positions at $650. So we each tell our clearing firm or our broker, lumber broker, our futures broker, hey, I just did an EFP. I did it with my good friend Greg Kuda. He clears through Westline Capital. I'm clearing through FC Stone or StoneX, right? And what happens next is StoneX contacts Westline Capital and they say, hey, we each have someone that is offsetting with each other, and you put in an offsetting trade. So for StoneX, I bought it at 600. I'm selling it at 650. There's a $50 profit that goes into my futures account. For you at Westline, you sold it at 700. They're putting a buy position in at 650. There's a $50 profit that goes into your futures account. You flip back to the cash side. What my relative cost for that cash trade is actually not 750, but it's 750 minus the $50 or $700 because I have that profit that's in my futures account. For you, you're not really selling it at 750. You're selling it at 800 because you have that $50 profit in your futures account. So the cash transaction happens totally separate than the futures transactions, and it's our clearing firm that handles all this for us. Now, you had said offline that there is the possibility that you get audited for this. So tell me, what exactly does that mean?
Yeah, so when you transact the physical side of this, what the clearinghouse and what the CME is going to want to see is a PO or proof. So first of all, can you physically take delivery of the cash? They're going to make sure that you can physically take delivery of the cash. And then they're secondly going to want to see details of the transaction. Here's the PO number, here's the invoice. This shows the tally that was agreed upon, the ship date, the price. It's going to give all the parameters of the physical cash side of the transaction. And so there's probably a 1%, 2% chance that on any given year you would have a EFP transaction audited, but that's just standard operating procedure. They're going to do this for all markets. They want to make sure that what was told to them actually transpired. So you want to go back and make sure that, hey, you said you were going to deliver this carload of cash within this time frame at this price. They're going to want proof of delivery. They're going to want proof that the money transacted between the two counterparties. They can control the they can control the futures side. They see it in the account statements. They see it through the clearinghouses. They just want to back check and make sure that the transaction, the EFP, you've got the exchange of futures for the physical carload of cash. They just want to make sure that the physical carload of cash was exchanged. Again, That's not every transaction. That's probably 1%, 3% of the time. But again, they're just doing their due diligence to make sure that the cash was actually transacted between the counterparties.
Okay. We're coming up on 30 minutes. The last thing I want to finish up is, why the heck would someone do this? What's the advantage of exiting a futures trade through the EFP market? I have an idea, but what do you think it is?
Yeah, so I'll give you two scenarios, and the perfect example is what's transpired with carrying this massive premium over the last month in futures, where sawmills, a sawmill has been on at 590 to 620 selling cash. You had November futures that traded to 700, that traded to 750, that traded to $79. I'm sorry, $790 a thousand. There are actual sawmills that sold $700 plus lumber when the traditional cash market was trading at 590 to 600. They're going to deliver, they're going to EFP that wood, and they're going to capture that premium that was in November. That's real money. That's tangible money in their pockets. The flip side of that is who's going to be buying lumber. Well, realistically, you're not going to be buying $750 November lumber to take delivery. But when print was 620 or 610 and November trades down to 570, 575, if I'm on the buy side, I can legitimately buy under where a mill is asking. And that's convert it into I own wood at that price. I'm either going to make it in the futures, the difference, or if that's wrong and the market goes to 550, then I'm still going to get that physical cash. Instead of buying cash at 620, I'm still buying at 575. So I'm still going to get the net benefit of buying a discount in futures.
And I would add on to that the execution risk, as volatile as the market is today, and we've seen some really wide spreads. If you want to be the aggressor and get out of a futures position, you have to move quite a ways. So yesterday I was watching the market. There were times where the bid ask was over $10 wide. That's $1,000 on a single contract, right? So by negotiating your exit point, you eliminate what I call the execution risk, or having to pay a premium just to exit your position. So I think it works out really well for both parties. They can put a strike price that's in the middle of a range between the bid and the ask.
Mike, I see somebody online, Kirk Miller, is asking about correlation.
Yep.
And as you converge toward expiration date, the correlation, you go from, if we remember, November was trading at $150 premium to physical cash. As you get closer and closer along the timeline to expiration, that convergence goes from 92% to 94% to 96% to 98%. So the convergence will always play out between the spot month, the front month futures, spot month futures, and physical cash as you get closer to expiration day. It doesn't have to play out in the sense that it doesn't have to be zero, but it will converge statistically time after time after time within 96 to 98%.
Yep. And, another way to look at correlations too is maybe you're able to secure from if you're the buy side, secure from a seller, an item that might be undervalued at that time.
Sure.
Or
Sure. And
if you're the seller, you might find someone that has a need for something that's overvalued.
so here's the other interesting part of this. If I'm on the buy side and I want to do business with a sawmill that doesn't necessarily I traditionally do business with, and I know they're on the short side, then that might give me the ability to start buying. Hey, look, we've got an EFP relationship. We're doing business together via EFPs. That can be a segue into doing business on the physical cash side with that sawmill, because you're a willing EFP participant with that mill. That can translate into doing business in a traditional cash, from a traditional cash standpoint down the road.
Yep, absolutely. All right, excellent. Great talk today. Let's wrap this up. How do you play futures with species outside of SPF? Say KD hug fir, KD hem fir, and Doug fir. I think, like Greg said, this is for Jim Schumacher. Like Greg had said earlier, it's not that important. You don't have to trade the lumber futures specified contract when you do an EFP. It's outside of the pit. It's outside of the jurisdiction of what the contract rules say. So you simply agree to a full carload, let the CME know what you're doing, and they allow it.
Yeah. And again, like to say that you're just going to blindly do something off of SPF. So you've got relationships with mills or with other counterparties that don't necessarily, they might not be Western SPF physical cash players. Maybe they trade hem fir, maybe they trade Doug fir, southern yellow pine, but you know that they're involved in futures. And that's where those relationships come into play, because when you do EFP, the counterparties are known to each other. Unlike the delivery process, the EFP process, each person knows who the other counterparty is. Yep. So we can definitely direct.
And I couldn't recommend enough, when you do decide to participate in the market like this, work with a professional like Greg, who has the established relationships and knows how the EFP process goes, because the paperwork needs to be done properly. Bottom line, you don't want to make a mistake. So with that in mind, let's wrap this up. Thanks again for coming, Greg. Anyone who's going to be down at the NOLA show, Materials Exchange has a booth there. Looking forward to seeing everyone, and we will talk to you all next week. Safe trading.
Safe travels, Mike. Have a good trip. Take care. Thanks, everybody.